Imagine a toddler born in 2026 who instantly receives a government-funded stock portfolio. Portfolio designed to essentially out-earn your entire lifetime pension by the time they hit middle age.
Which is a wild concept to wrap your head around.
It really is. Welcome to July 1st, 2026. As we cross the midpoint of the year, the markets, they aren't being driven by predictable central bank moves or your standard earnings reports anymore.
No, the actual capital flow of the global economy is currently being rewritten by some, frankly, bizarre policy incentives, along with, fascinating shifts in human behavior.
Welcome to Claire and Horatio Financial Candy, where we unpack the mechanisms, the money weirdness, and the invisible forces shaping your financial reality.
It set the analytical baseline for the second half of this year. We kind of need to look under the hood of recent market performance. The first half of 2026 saw massive technology sector gains. Emerging market tech actually outpaced the U.S. giants, right?
Wow.
A remarkable 90% jump. Exactly, a 90% jump. But those surface-level stock charts, they are hiding the real friction. Because physical infrastructure limits and extreme shifts in consumer psychology are starting to dictate the terms of global trade.
And today, we are mapping out those underlying mechanisms. We are tracing the money from new federal toddler accounts through the complexities of global automotive supply chains, all the way down to why young workers are just entirely abandoning the concept of a traditional retirement.
It is a lot of shifting ground.
So let's start with a major policy shift hitting the U.S. economy in just a few days. On July 4th, the new 530A accounts, which are widely being referred to as Trump accounts, officially launch.
Right, and these 530A accounts represent this structural attempt to force capital returns into the hands of the working class. The Treasury Department is providing a one-time $1,000 pilot deposit for babies born between 2025 and 2028.
So the core mechanism here is basically a tax-advantaged investment vehicle specifically geared toward long-term generational wealth, like a 401k for a baby.
That is essentially what it is. And the private sector is layering on top of this public policy, too. For older children, the ones born between 2016 and 2024, who don't qualify for that initial Treasury deposit the Dell Foundation is stepping in.
Oh, with the grant program, right. They pledged a $250 grant for those kids, provided they live in specific lower-income zip codes.
Yes. And you also have the user interface side of this, which is crucial for adoption. The app is managed by BNY Mellon, but designed in partnership with Robinhood.
Which brings a whole very specific gamified behavioral design to managing a child's wealth.
It does. But the macroeconomic theory behind all of this is pretty straightforward. Returns on capital today vastly outpace returns on labor. So if you want to democratize market growth, you force money into U.S. equities early.
Giving a child a half-century time horizon to compound in the upside of companies like Alphabet or SpaceX.
Exactly.
But if you run the compounding math on this, the numbers are staggering, but they also reveal this massive flaw in the behavioral economics of the policy.
The wealth gap issue.
Yeah. Projections show that just the initial $1,000 deposit, assuming historical market returns, and literally zero further contributions, could grow to nearly $243,000 by age 55.
Which sounds great on paper.
It does, but here's the catch. Families can legally contribute up to $5,000 a year in after-tax dollars to these accounts. If a family maxes out that annual limit, the account reaches $13 million by age 55.
Right. And if you are struggling to pay rent or cover your summer cooling bill, you do not have $5,000 in disposable cash lying around to park in a toddler's brokerage account.
Exactly. So that gap creates a highly specific systemic risk, doesn't it?
It absolutely does. The initial seed money provides a universal baseline, but the ongoing contribution structure inadvertently acts as a wealth multiplier for households that already possess liquidity. It just concentrates the long-term compounding benefits in higher income brackets.
And furthermore, this policy is heavily engineered to drive domestic U.S. stock investment, which seems to operate in tandem with a broader, much more aggressive push to domesticate physical U.S. industrial supply chains.
Yes. And we're seeing the friction of that domestication play out right now with the United States and Mexico-Canada agreement. The deadline to extend the USMCA Auto Pact just passed on Wednesday without a deal.
thrusting the entire North American automotive market into this uncertain annual review process.
Well, the current administration is pushing for highly aggressive compliance thresholds. They want to increase regional auto content rules to 82%.
But more critically, they are demanding a strict mandate that 50% of a vehicle's value must be produced specifically within the United States, right? Because under the previous framework, there was no requirement separating U.S. parts from Canadian parts.
Right. And try to picture the logistics of actually separating those supply chains.
Yeah.
I mean, a single modern vehicle contains roughly 20,000 individual parts, sourced from up to 120 different countries.
So consultants are estimating a 20% cost premium just to shift parts production from Mexico to Canada. And if an automaker tries to move production from China to the U.S., they're looking at a 50% increase in costs.
A massive jump. The mechanism the administration is relying on here is the threat of tariffs at the border for non-compliance.
But when you look at the raw cost analysis, it reveals this fascinating unintended market incentive because the math actually incentivizes the exact opposite of the policy's goal.
Oh, so?
Well, if hitting that 50% domestic standard requires billions in supply chain restructuring, automakers might simply run the numbers and realize it is cheaper to build cars entirely outside the U.S. using affordable global parts.
Oh, and just willingly accept the tariff penalty at the border.
Exactly. Paying a penalty on a vehicle that costs significantly less to manufacture might still leave them with a higher profit margin than trying to manufacture entirely within U.S. borders. The policy meant to force domestic production might actually push it away.
That is a wild incentive structure. Though we do see a similar force-feeding of domestic capital working effectively in the defense sector. The U.S. defense budget has allocated an unprecedented $75 billion specifically for drone modernization by 2027.
And this isn't just military spending, is it? It is an active reshaping of private defense markets to establish American dominance in autonomous systems.
Correct. Consequently, companies positioned to capture that domestic capital are seeing massive influxes of investment. Like AeroVironment stock recently surged 19% after just obliterating their revenue estimates. And that was driven almost entirely by these new procurement pipelines.
So we have been talking about the domestication of corporate and national supply chains, but there is a parallel trend happening in personal brand monetization.
The Trump financial disclosure.
Yeah, the U.S. Office of Government Ethics just released a 927-page financial disclosure for President Trump covering 2025. And when you strip away the politics and just look at the mechanics, this document outlines how modern political figures operate as highly diversified holding companies.
The sheer scale of the brand licensing infrastructure is the real story here. I mean, the disclosure reveals over $580 million generated from World Liberty Financial World, which is an entity involving crypto tokens and equity.
And another $635 million came from what are termed celebration coins. Plus, you have millions generated from licensing the brand for physical products. We're talking branded Bibles, sneakers, and a perfume retailing for $249.
Melania Trump's financials also show a $10.7 million net from an Amazon documentary.
The filing also details how legal disputes are being monetized and redirected. Over $86.5 million in legal settlements from media companies like Meta, ABC, and CBS are being channeled to entities like the National Mall Trust and presidential libraries.
But the detail that really stands out is the pattern of actively managed equity trading.
Oh, the NVIDIA trades. The disclosure shows massive purchases of NVIDIA stock valued somewhere between $5 and $25 million. And what makes that interesting is the execution timing.
The purchases occurred just a week after a major policy announcement where the government agreed to let NVIDIA resume selling specific AI chips to China in exchange for a 15% revenue cut.
So those NVIDIA trades highlight the intersection of policy knowledge and market timing. But the crypto revenue figures in this disclosure present a fascinating market contradiction.
Because those millions in crypto-related licensing arrived during what the broader market is currently calling a severe crypto winter, I mean, the asset class has been in a sustained 9-month slide.
Right. If you are an active retail trader, how are you even surviving a 9-month slide to launch new tokens into? If the asset is plummeting, the traditional aggressive move is to short the market.
But naked shorting in crypto is essentially financial suicide.
Because if a token suddenly rockets upward in a random bear market rally, your losses compound to infinity. You could literally lose your house on a single trade.
Retail traders understand that risk, which is why the mechanism for survival right now relies on defined risk options strategies.
Sophisticated retail investors are trading crypto proxies, right? Like Strategy Inc., the company formerly known as MicroStrategy.
Yes, using a structure called a bear call spread, or credit spread.
Let me try to put this in normal human terms. A bear call spread is essentially like selling a high-priced lottery ticket to someone who thinks the stock is going to go up, while simultaneously buying a cheaper, crazier lottery ticket for yourself further out, just in case they are actually right.
That's a good analogy. You collect the premium upfront from the ticket you sold. If the stock goes down, or even just stays completely flat, both tickets expire worthless, and you keep that upfront premium as pure profit.
But the vital part of that mechanism is the cheaper ticket you bought. That acts as your insurance policy. It draws a hard mathematical line on your potential losses.
In a volatile asset class during a crypto winter, traders are prioritizing the capping of maximum loss over unlimited upside. It is a highly defensive posture.
And investors are having to play defense across the board because traditional safe havens are also buckling. Look at gold. It just suffered its worst quarter in 13 years, dropping 16% in the second quarter of 2026.
Which isn't a failure of gold itself, really. It is a reflection of how higher interest rates fundamentally rewrite the rules for non-yielding assets.
If you can get a decent yield holding cash in a savings account, holding a physical block of metal that pays you zero interest suddenly carries a massive opportunity cost.
Speaking of opportunity costs, before we move on to the fiscal limits affecting global supply, a quick reminder: if you are looking to understand the forces moving your own portfolio, or just want to explore more complex systems, you can find Financial Candy, Brain Candy, and classic audiobooks at clarinhoratio.com.
Let's shift from the friction in financial markets to the very real physical friction happening across the global grid right now. The broader economy is currently fighting the physical limits of extreme heat.
We are seeing critical infrastructure failing because it was engineered for a climate baseline that simply no longer exists.
In late June, temperatures in France hit 40 degrees Celsius. The ambient heat was so severe that a heavy metal electrical transformer in Brittany completely melted down, severing power to over 100,000 people.
And in the UK, cooling systems at Guy's and St. Thomas's hospitals failed. The interior temperature of their data centers reached 50.3 degrees Celsius.
They were forced to cancel medical operations because the digital infrastructure required to run the hospital physically could not function.
And the grid itself becomes a liability in this heat. Grid operators are being forced to intentionally limit the electricity supply because high voltage running through metal power lines generates internal heat.
When you combine that internal heat with extreme ambient temperatures, the metal physically expands and sags. If those sagging lines droop into trees or buildings, you trigger massive fires.
This creates a compounding problem for renewable generation, too. The assumption is usually that sunny, hot days are perfect for solar power.
But the physical properties of silicon dictate otherwise. When temperatures climb above roughly 27 degrees Celsius or about 80 degrees Fahrenheit, solar panels actually lose efficiency.
Right, the excessive heat increases the resting energy of the electrons in the panel, which reduces the voltage difference the panel can actually generate.
So precisely when the grid is under maximum strain, with millions of air conditioning units running full blast, the efficiency of solar output plateaus and begins to fall.
Which forces the question: if the physical grid requires constant monitoring, limits, and emergency repairs just to survive a standard summer week, who absorbs the cost of that inefficiency?
The consumer absorbs the cost directly. Millions of households in the UK are seeing their energy price cap rise by 13% as of today, July 1st.
For a typical household paying by direct debit, that increase translates to roughly $24 more a month.
When you scale that across the population, the friction becomes a macroeconomic burden. National energy debt in the UK has ballooned to a staggering record of approximately $6.4 billion.
Now, this specific price hike in the UK is actually a delayed reaction to earlier wholesale gas spikes, the ones caused by the US-Israel-Iran war.
But if you look at the supply side today, the market dynamics have drastically reversed. The U.S. officially ended its naval blockade of Iranian ports in June.
And since that blockade lifted, Iran has flooded the market, exporting over 40 million barrels of crude oil.
The pricing mechanism reacting to that flood of supply is remarkable. Iran is currently selling that oil at a 20% premium over the deeply discounted rates they were forced to offer prior to the war.
Yet despite Iran charging a premium, the global benchmark, Brent crude, has fallen 40% from its April peak, trading near $73 a barrel.
The mechanism overriding Iran's premium pricing is just simple, unhindered transit flow. The Strait of Hormuz is temporarily flowing again under a 60-day transit agreement, which completely alleviated the massive supply bottleneck that had previously terrified global energy markets.
When you combine these volatile compounding energy bills with the constantly shifting timelines for state safety nets, it fundamentally alters consumer psychology. It changes how an entire generation interacts with the financial system.
Take Gen Z in the UK, workers born between 1997 and 2012. Right now, half of that generation firmly believes the state pension will not even exist by the time they reach the climbing retirement age of 68.
And their skepticism is grounded in demographic reality. The state pension currently guarantees about $323 a week, but by 2050, the UK is projected to have 15 million pensioners.
That massive non-working population will need to be supported by a proportionally shrinking base of working-age taxpayers. The structural math simply does not support the current promise.
When a 25-year-old looks at that demographic math, their behavioral response is highly rational. We are seeing a massive trend of young workers intentionally opting out of automatic workplace pensions.
They are doing this because they desperately need liquidity right now just to cover rising rent or to attempt to save for a house deposit. I mean, why lock away capital for 40 years in a system you believe will collapse when you need that cash to survive Tuesday?
We are also seeing a spike in mini retirements, these grown-up gap years, where young professionals intentionally leave the workforce to travel or rest. They are prioritizing experiences today over a theoretical 40-year safety net.
While that choice solves an immediate liquidity problem for the individual, it introduces a severe systemic risk to the broader economy, doesn't it? Future pensioner poverty.
This risk is exponentially higher for lifelong renters. If a worker enters retirement at age 68 without the equity of property ownership and without a capitalized private pension pot, they are left relying solely on a strained state system.
The downstream economic outcomes of that scenario are incredibly grim, and that loss of consumer confidence, the need to hoard cash today against an uncertain future, isn't just a 2050 problem. It is bleeding into global retail earnings right now.
You're talking about Nike's recent fourth-quarter earnings report.
Yeah. They actually beat revenue estimates, pulling in $10.97 billion. But their shares slipped heavily in after-hours trading.
Because management warned investors about a forward-looking deceleration in sales, specifically pointing to a struggling, highly cautious Chinese consumer base. Consumers who are feeling economic anxiety simply do not buy premium sneakers.
However, the financial markets rarely move in a single unified direction. While Nike's management worries about Chinese consumer caution, options traders are looking at that exact same market and making a massive contrarian bet.
The broader Chinese large-cap ETF is down 18%, trapped in a grinding 9-month bear market. Yet traders are currently executing highly aggressive bullish bets on Chinese internet stocks.
They are buying hundreds of thousands of call options, placing a specific mathematical bet on a 23% rally in that sector by December. How do you even square that? Why bet on a massive rally when the consumer base is explicitly terrified to spend money?
It is a high-stakes game of chicken with market sentiment. The traders executing these bets are operating on the assumption that systemic pessimism eventually bottoms out.
Markets tend to overreact to bad news, so they're betting that the panic has been fully priced in.
Exactly. And when the sentiment eventually pivots, the upside reversal will be violent and rapid enough to make those cheap, out-of-the-money call options incredibly profitable.
We have spent this entire episode analyzing the mechanisms of people opting out. Gen Z skipping their pensions for immediate cash, retail traders hedging against a brutal crypto winter, even automakers running the math on ignoring domestic production mandates.
It's a running theme of avoidance.
But I want to close by looking at a much older, much more eccentric example of opting out of the modern economy entirely. We recently learned of the death of Humphrey Smith at age 81. He was the fiercely private owner of the Samuel Smith Brewery in North Yorkshire.
Humphrey Smith's business model stands as a fascinating case study in absolute economic leverage. He operated his 200-pub empire under an unlimited company structure.
In the UK, an unlimited company offers no limited liability protection for the owners, right? But in exchange, it exempts the company from publishing its financial statements.
Which allowed him to maintain absolute legal financial secrecy from the public and from his competitors.
But the financial secrecy was just the foundation. His real leverage was entirely managerial. He famously banned mobile phones, music, televisions, and even swearing in all of his pubs.
He explicitly engineered these spaces to force human interaction, describing them as havens from the digital world.
If you pulled out a phone to check a text message, you were literally kicked out of the pub.
To enforce a rule that actively antagonizes modern consumer habits, he had to restructure the traditional pub industry model. He fired traditional tenant landlords who run pubs as independent businesses and want to attract as many customers as possible.
And he replaced them with direct managers who were strictly employed by the brewery. That structural change gave him ultimate authority.
A tenant landlord would fight a phone ban because it hurts sales. A direct manager simply enforces the rules of the owner.
It created an entirely different kind of economic moat. Usually, a business moat relies on proprietary technology, patents, or massive economies of scale.
But Smith's moat was his absolute authority to cultivate a highly curated analog environment by deliberately rejecting every single modern consumer expectation.
Which leaves you with this thought to mull over. In a July 2026 economy completely obsessed with autonomous drone budgets, political crypto tokens, and algorithmically optimized supply chains, what is the actual financial premium of creating a physical space that explicitly bans all of it?
It is a potent reminder.
It really is. As the noise of the global economy gets louder, sometimes the rarest, most valuable commodity you can offer the market is just a little bit of quiet. Thank you for joining us for Claire Nourishio Financial Candy. Keep questioning the mechanisms around you, and we will see you next time.